It is going to be good enough to take markets to new highs, because what you have to look at is, even with all of the bad news out there, we're seeing corporate revenues grow substantially faster than the economy. And that reflects the fact that people are working. You talked at the end of the last show about how we're seeing strikes because the labor market is so strong. Those people are making money, and those people are spending. And that's going to keep driving revenues, and earnings are probably going to beat expectations as well.
So, Jamie, why don't you chime in here? What do you think is the sort of overarching theme of the next year or so, and how should you position or reposition your portfolio to catch the wind?
Well, I think you can call me a value bull. I think we're in the part of the cycle, Tyler, where, it makes a lot of sense for investors to reorient their portfolios to things with much more sustainability. I mean, we're looking at a corporate debt situation that could really spiral out of control. I think that if you look at companies like Daimler and look at, and compare them to Ford, you have a situation brewing where companies have really overborrowed and had used that money to fund buybacks and dividends and things like that, which has produced a situation where companies have been spending way more than their free cash flow. So to me, I think investors need to pay close attention to the stocks they own, to try to figure out the ones that have the ability to cover those interest payments, continue those dividends, and actually be sustainable in the future. One of the examples, Daimler, Procter & Gamble, and even something like Nestle would be good three examples for investors to consider. I don't think the U.S. economy is going into recession in the next year or so. I think that's going to be fine. I agree that the economy is pretty stable, but I do believe that stocks in the U.S. are becoming very stretched, and it's actually going to be easier for investors to own these more value-oriented names. Do it now before it's too late.
I totally understand that sentiment, Jamie, but at the same time, in that table where you had mentioned Daimler, Nestle, as well as Procter & Gamble, you also have the example of ExxonMobil. ExxonMobil has about a 5% dividend yield, but it's down 16% over the past 12 months. So you're in a case where dividend yield is not making up for the loss in principal that you're suffering as an investor.
Agreed. I 100% agree with that, but we're looking to the future, not the past. And if you're looking at a good time to buy a company like ExxonMobil, this would be a good opportunity to do so. I believe that when you're talking about owning the shares and looking at the companies in general, the ability for them to sustain that cash flow or sustain the dividend payments is really, really important now. So as an investor, I take the other side and say, 2 years from now, 3 years from now, I'll be glad to be an ExxonMobil investor as opposed to perhaps one of the other companies like Valero or something like that, where they may be in a debt situation where they have to cut those things back if debt service becomes a problem. So I believe that the debt service ratios and things like that are more favorable, and for a longer term or even a couple of years from now, that's going to be a better place to be.
Let's talk, Brad, a little bit about buybacks. And are you one who believes that they are drying up? And if they are, will that lack of sort of tinder affect the market more broadly? I'm not talking about the dating site, okay?
No, I think what you're seeing here is we might see buybacks pull back a little bit, but there's two things you need to remember there. First of all, we saw buybacks increase from about $800 billion last year to about $900 billion this year. So they can pull back a very considerable amount and still be at a very healthy level. The second point is this. We're talking about generally new announcements of buyback programs. A lot of the announcements that have already taken place still have some room to run. So we're not talking about a cliff, first of all. We're talking about maybe a slowdown over time. Second of all, we're talking about still a very high level of buybacks. And because of that, I don't think that's going to be the thing that takes the market down.
Okay.
There's a lot of headwinds, but that's not going to be it.